Today I'm sharing the ultimate 5 ETF portfolio for 2025 that can make you up to $1.7 million. So if you've been confused about which ETFs to choose, how much to allocate to each, or how to build a portfolio that will actually grow your wealth, this video will give you the exact blueprint. I'm going to explain why they're exceptional investments for 2025 and share my recommended allocation percentages for maximum growth. I'll cover their expense ratios, historical performance, top holdings, and how they work perfectly in both a TFSA, Roth IRA, and RRSP 401k accounts. I'll also be giving my US and Canadian recommendations for each ETF, so this video will work for everyone watching. By the end of this video, you'll have a clear, actionable investment plan that takes less than 30 minutes per year to maintain. Let's start with the cornerstone of any investor's portfolio, and that is VFV for Canadians and VOO for Americans, the Vanguard S&P 500 Index ETFs. VFV has an expense ratio of 0.09, while VOO has an even lower expense ratio of 0.03, which means if you purchase VFV, you're paying only 90 cents per $1,000 invested annually, while VOO investors pay just 30 cents per $1,000. These ETFs track the S&P 500, giving you ownership in America's 500 largest companies. The top 5 holdings for both are identical. Apple at approximately 7.3%, Microsoft at 7.1%, Nvidia at 4.8%, and Amazon at 3.6%, and Alphabet, Google at 3.5%. Together, these 5 companies make up over 26% of the entire fund. Over the past decade, the S&P 500 has delivered an average annual return of approximately 11%. And to put that in perspective, if a Canadian investor puts $7,000 today in VFV and adds $7,000 annually with this 11% return rate, in 30 years, they could have approximately $1,748,000. An American investor doing the same with VOO would have $1,761,000 thanks to the slightly lower expense ratio. That's the incredible power of compound growth. And the reason why Canadians typically don't purchase VOO directly is because of the 1 to 2% currency conversion fees when buying US listed ETFs, which can completely offset those savings. That's why VFV makes more sense for most Canadians. You get essentially the same investment without the currency hassle. I recommend allocating 70% of your portfolio to VFV or VOO for strong, stable growth. It's the foundation everything else builds upon. And really quick, I've noticed over 80% of viewers who watch aren't subscribed. An easy way to support the channel is by hitting that subscribe button, and I personally commit to continue providing quality educational content with each video. And speaking of quality investments, let's talk about an ETF that could supercharge your returns: QQC for Canadians and QQQ for Americans for exposure to the NASDAQ 100. QQC has an expense ratio of 0.2%, while QQQ has the exact same ratio of 0.2%. This means you're paying $2 per $1,000 invested annually. What makes these different from VFV and VOO? While there are some overlap in holdings, these ETFs focus predominantly on tech innovation leaders rather than the broader market. The top 5 holdings include Apple at approximately 11.7%, Microsoft at 10.5%, Nvidia at 7.2%, Amazon at 6.2%, and Meta Facebook at 4.2%. Technology companies make up nearly 50% of these funds compared to around 29% in the S&P 500's ETFs. Over the past decade, the NASDAQ 100 has significantly outperformed the S&P 500, delivering an average annual return of around 18%. With this return rate, a $7,000 initial investment with $7,000 annual contributions would grow to approximately $4,115,000 for Canadians using QQC and $4,115,000 for Americans using QQQ. After 30 years, they're identical because they have the exact same expense ratio. I recommend allocating 10% of your portfolio to QQC or QQQ for higher growth potential. While this higher concentration in tech means slightly more volatility, the growth potential makes it worth the risk for that portion of your portfolio. This is where the real magic happens for long-term wealth building. Next is XIC for Canadians and EWC for Americans. XIC is the iShares Core S&P TSX Capped Composite ETF with an expense ratio of just 0.06, while EWC is the iShares MSCI Canada ETF that has an expense ratio of 0.5%. That's a significant difference. XIC costs just 60 cents per $1,000 annually, while EWC costs $5 per $1,000. These ETFs represent the Canadian stock market, with XIC being more comprehensive, covering approximately 95% of Canadian equity market with over 230 holdings. EWC is more concentrated with about 90 holdings. The top 5 holdings for XIC include Royal Bank of Canada at 6.3%, Toronto Dominion Bank at 5.2, Shopify at 4.7, Canadian National Railway at 3.8, and Enbridge at 3.5. For EWC, top holdings are similar, but with slightly different weighings. The Canadian market has delivered an average annual return of about 8% over the last decade. With this return rate, a $7,000 initial investment with $7,000 annually would grow to approximately $923,000 for Canadians using XIC and $874,000 for Americans using EWC after 30 years, and that difference is due to the higher expense ratio of EWC. I recommend allocating 10% of your portfolio to XIC or EWC. While the Canadian market doesn't have the same growth rate as the US, it offers excellent exposure to financial, energy, and material sectors, providing important diversification benefits. Now, let's look at XEF for Canadians and EFA for Americans. XEF is the iShares Core MSCI EAFE IMI Index ETF with an expense ratio of 0.22%, while EFA, the iShares MSCI EAFE ETF, has an expense ratio of 0.32%. This means XEF costs $2.20 per $1,000 and EFA costs $3.20 per $1,000. These ETFs give you broad exposure to developed international markets, excluding North America, covering approximately 2,500 companies in XEF and about 800 in EFA. The top 5 holdings for XEF include Novo Nordisk at 2.1%, ASML Holdings at 1.8%, Shell PLC at 1.4%, AstraZeneca at 1.3%, and Toyota Motor Corp at 1.2%. EFA has a similar top holdings, but slightly different weighings again. Developed international markets have delivered average annual returns of about 8% over the past decade. With this return rate, $7,000 initial investment with $7,000 annually would grow to approximately $910,000 for Canadians using XEF and $898,000 for Americans using EFA after 30 years. These ETFs are crucial for proper global diversification, accessing economies with different growth cycles than North America. I recommend allocating 5% of your portfolio to XEF or EFA. And by the way, you can check out a free investment profit calculator that you can use to see exactly how much your portfolio could grow to over time with these ETFs. Just click the link in the description to access it or the first pinned comment. You can input different contribution amounts, time horizons, and expected returns to create your personalized wealth projection. It's the same tool I use for all my investment planning, and you can check it out completely free. And finally, there is XEC for Canadians and IEMG for Americans. XEC is the iShares Core MSCI Emerging Markets IMI Index ETF with an expense ratio of 0.26%, while IEMG, the iShares Core MSCI Emerging Markets ETF, has an expense ratio of 0.09. This means XEC costs around $2.60 per $1,000 invested annually, while IEMG costs just 90 cents per $1,000, a rare case where the US version is significantly cheaper. These ETFs focus on rapidly growing economies, with XEC covering approximately 2,800 companies, while IEMG about 2,500 companies across emerging markets. The top 5 holdings for both include Taiwan Semiconductor Manufacturing at 6.1%, Tencent Holdings at 3.9%, Samsung Electronics at 3.2%, Alibaba Group at 2.5%, and Reliance Industries at 1.3%. Emerging markets have delivered an average annual returns of around 7% over the past decade. With this return rate, a $7,000 initial investment with $7,000 annual contributions would grow to approximately $754,000 for Canadians using XEC, $776,000 for Americans using IEMG after 30 years. And once again, the difference is due to the lower expense ratios of IEMG. So I recommend allocating 5% of your portfolio to XEC or IEMG. While emerging markets come with higher volatility and risk, they also offer significant growth potential and crucial diversification benefits. So my recommended allocation is 70% VFV or VU, 10% QQC or QQQ, 10% XIC or EWC, 5% XEC or IEMG. This gives you comprehensive global exposure with an emphasis on the US markets where the strongest growth has historically occurred. Now, let's talk about expected returns of this portfolio as a whole. Based on historical performance and a weighted average of each ETF's return, this portfolio could potentially deliver 11.3% annual returns with a $7,000 initial investment and a $7,000 annual contribution. This could grow to approximately $1,865,000 for Canadians and $1,888,000 for Americans after 30 years. But why am I so bullish on the US market compared to the Canadian international markets? The answer lies in innovation and economic resilience. The US continues to dominate in technology development and has more diverse sector representation and has consistently demonstrated stronger growth even during global downturns. The S&P 500 has outperformed both the Canadian markets and international developed markets in 7 of the last 10 years, often by significant margins. Here's what makes this portfolio truly powerful. It's simple enough for beginners, it's sophisticated enough for experienced investors. You get exposure to approximately 3,000 companies across 45 countries with just 5 ETFs. This weighted average expense ratio is only about 0.11% for Canadians and 0.08% for Americans, keeping more money working for you instead of going to fund managers. And with quarterly rebalancing maintenance, it takes less than 30 minutes per year. This is the definition of working smarter, not harder with your investments. Now, my personal TFSA looks quite different because I've built it over time and I have much higher risk tolerance due to my expertise. I currently have 50% in VFV, 5% in QQC, 5% in XIC, 5% in XCF, 5% in XEC, and a full 40% in individual stocks where I believe they will actually outperform the market. But I want to be crystal clear. I absolutely do not recommend my personal allocation unless you're extremely hands-on with your investments like I am. I spend 7 days a week thinking about investments, analyzing company reports, and staying on top of market trends. For most investors, this level of commitment just isn't realistic or necessary. And I'll be doing a deep dive into my own personal portfolio in the future for those interested in my more active approach. But if I was starting fresh today and I wanted a more set it and forget it approach, I'd follow exactly the allocation I recommended to you today. The beauty of these ETFs is that they work perfectly in both TFSAs and RRSPs for Canadians or Roth IRAs or 401ks for Americans. For tax optimization, I generally put US focused investments in my RRSP to avoid that 15% withholding tax on dividends that occurs in TFSAs. And the allocation I shared today isn't just theory, it's backed by decades of market performance data and portfolio optimization principles. The 70-10-10-5-5 split provides an ideal balance of growth potential and risk management. It's diversified enough to weather market storms, but concentrated enough in high-performing segments to outpace inflation and build significant wealth. Consider this. If you had used this allocation strategy starting in 2015, you would have achieved an average annual return of approximately 11.5%, beating both the Canadian market, approximately 7.8%, and a traditional 60-40 stock bond portfolio, approximately 8.3%, by a substantial margin. And unlike complex investment strategies requiring constant attention, this approach takes minimal time to maintain, freeing you up to focus on your career, family, and other pursuits. And for those wondering about timing, like should you invest all at once or dollar cost average, the data shows that lump sum investing outperforms dollar cost averaging about 2/3 of the time. However, if you're concerned about market volatility or investing a particularly large sum, spreading your investments over 3 to 6 months can provide psychological comfort without significantly impacting long-term returns. And I actually suggest dollar cost averaging now in today's market. A good example is what happened to me. I contributed to my TFSA right at the beginning of the year. I purchased more VFE like I always do on autopilot every year, and then the price plummeted. I was expecting a drop, but nothing like this. Luckily for me, I had actually sold a large position in VUG, my TFSA, at its all-time high. So I actually had plenty of room in the account to purchase more shares of VFV and individual stocks during that recent market low. But this definitely changed my TFSA strategy moving forward. I'm going to dollar cost average whenever I feel like there is obvious instability in the market. So if you're serious about building wealth in 2025, consider this portfolio for both Canadians and US options. VFV, VOO, 70%, QQC, QQQ, 10%, XIC, EWC, 10%, XEF, EFA, 5%, XTC, IEMG, 5%. And remember, the best investment strategy is the one that you can stick to consistently. Thanks for watching, and check out these 2 videos for more investment tips. Bye guys.